All right, folks, welcome back. It's our weekend commentary for the ICT Mentorship for September 24th, 2021. As a production note and reminder, so that way you're not surprised, there will not be a video Monday. I have a friend visiting with me that's unexpected, so I'll be spending time with them. If opportunity presents itself where I can obviously do a Monday upload, then obviously I'll certainly do that. But just so you guys know, there won't be a video that's at least scheduled for Monday. As a result of that, I'm not going to include a homework assignment for tonight, so enjoy your weekend, and we'll catch up with each other on Tuesday. All right, so here is the dollar index daily chart. I'll try to go through this as smoothly and as efficiently as I possibly can. All right, so yesterday I mentioned we had a down close outside day. Okay, so yesterday's high went above the previous day's high and lower than the previous day's low. And generally that creates a bullish scenario. And you can see we had a little bit of a pop in here. Now notice, because it's Friday, this is also why I was a little bit reluctant to get all that excited about it. Had it been like this was on a Wednesday, then I would have expected Thursday and Friday to maybe run up into here. So that's for your notes. That's something like algorithmic theory there. So if this would occur, where it gives us more time of the weekly range, whereas we're just right now creating the Thursday down close, it doesn't give us the likelihood, at least in terms of high probability, for it to continue and drive up into here. Now it could have done that, and I made the possible outcome of that happening for today, or Friday, likely, but in my opinion, more unlikely. So like I said, I mentioned that we would not likely see a follow through, but it'll be interesting to study. So you can see we did get an up close day. For day trading purposes, it was beneficial, I guess, to study intraday delivery, but try not to make too much of it. Now, we did create a swing high, and I don't want to make too much of that either because it was just a Friday, closing with a lower high. Do we drop lower and go into this area? And here, again, like I mentioned yesterday, I'd rather not see that. So I want to see, hopefully, a gap higher on Sunday. Okay, so I want to see a gap higher from where we closed on Friday. So a gap opening up here, and then maybe try to press up into the high that's formed on Thursday, and then maybe accelerate into Monday, Tuesday's trading to get up into here. That's what I would like to see. Obviously, anything can happen over the weekend. Anything can happen on Sunday's opening. That's always a gamble, if you will. We don't really know what's going to happen, so we have to play it by ear. All right, so if you drop down into your hourly chart, you probably notice this, okay? This big old wick here. Now, that, to me, obviously has to be a misprint of some kind. It doesn't appear on the daily chart, but it does appear on the hourly chart. So when you get this problem for dollar, how do you fix that? Well, you can see that we're pulling the dollar index TVC. So that TVC is our normal go-to in the mentorship commentary. But if you go to the dollar index, just using the same symbol, DXY, and then pull up the ICE futures contract. Okay, you'll see this here instead of the TV previous, in other words, instead of looking for this one, when you load a Dixie, DXY, for dollar index, if you simply just look for this one, then you'll get the corrected view. Now, the question is going to be, can you use this one instead of the other one? Sure, there's no problem. You may prefer to use this one. I have just grown accustomed to using the TradingViews version of that other one, and creature of habit, I just go for it. This here is just as good. It may be a little bit cleaner for your charts. You may prefer that. The ideal scenario is obviously looking at it from a subscription basis. So you may have to pay for a subscription if you're not using a service that makes this available. So just bear that in mind. All right, so you can see we have a small little sell sign and bounce, buy sign and efficiency formed here on the 23rd of September. The market traded up into that. Didn't quite fill that in, but I like the fact that, like I said, we went down below the previous day's low here, creating that outside day, higher high and lower low. Then it rallied, created a small little imbalance. Okay, so that's the little signature I teach you to look for. Does the market give us that little bit of a a confirmation, if you will, or just an alert, like a billboard sign saying, "Hey, pay attention to me. I'm likely to do something here," and it creates that little gap. The market creates a short-term break in market structure there. Now, you may not look at that and say, "Oh, come on, ICT." It's all you need. Remember, the bias was I said that this is probably an outside day with down close that could be bullish. I'm just not terribly bullish because it's going into Friday. And they took it all the way back down to knock out those individuals that were going long here. They did that. Okay. So much in the same way, they went back up here to take out anyone that was short. So I don't want to make too much of it either way. The point is, from an intraday basis, we see that little signature here where it does rally, comes back down into the fair value gap, and then rallies, and then sends it aggressively into this imbalance here. It left that open, so for interpretation purposes, just attribute it as it's Friday. Okay, it's not likely to go above the previous day's high because we've already ran that scenario out, and it's not enough room to really carry us into the close of the week strong, in my opinion. So we do have a small little imbalance here. Do we drop down into that on Sunday? I'd rather see it stay open. And again, I would see it gap up, come back down, fill in the gap, and then continue higher. That's what I'm looking for. Or if we gap higher and we trade into this imbalance as a support level, that would be just as well for me as well. I mean, I wouldn't be upset about that either. That would support, in my mind, continuation on the upside on dollar index. And again, look at that symbol right there if you're trying to pull up the Dixie dollar index, and you won't get that hourly spike up that's not really, in my mind, valid. All right, here is the 15-minute time frame, and you can see how after midnight we just roll right on up, pumped it up into the imbalance in here. Optimal trade entry there, sells off, then consolidates into the close of the week. All right, euro dollar, small little rally up in to that imbalance once more. Small little Judas swing, and then sells off. It didn't get aggressively bearish, but it did offer an opportunity to get a little scalp in here if you were looking for it again. On the hourly chart, euro dollar, we went right back under that imbalance I mentioned. We just hanging in there and dropped us lower right into this imbalance right there. So it short-term little retracement off of that into this imbalance and into the close of the week. I'd prefer to leave the balance of this in here left open. So between this candle's low and this candle's high, I'd like to see that remain open and just gap down, fill in the gap on Sunday, and then making a run in here. That's what I'd prefer. 15-minute time frame, euro dollar. Again, you can see we left the old imbalance on the daily chart, hammered into the bottom of that as resistance, sells off, small little gap in here, trades back up into that, and then consolidates into the close as I mentioned. Nothing in here really terribly exciting. It's better, I guess, viewed on a 1 and 5 minute chart, all in here. Outside of Wednesday's trading, that day alone was where my focus was, as I hinted to the previous week, saying that the economic calendar, we have FOMC, just be mindful of that. There are people, obviously, opposed to trading ahead of high impact news, and FOMC is one of those things. But after FOMC data hits the market and it creates an imbalance, then you can go and engage, like I just shown on Wednesday's trading. I'm not trying to teach, and please don't take this out of error by me showing you that trade, thinking that you should be trading ahead of FOMC. If you look at it, it was after those numbers hit the market and the market created its initial run. Then I faded that move. Okay, so it's not to inspire you to trade FOMC related news events. It's just I'm showing you after that news hits the marketplace, I can see, as I teach you here in this mentorship, with a great deal of visibility, what they're likely to be doing, what they're likely to do after that initial manipulation. All right, British pound versus US dollar daily chart. Okay, small little retracement in here. It went right down to the order block there. So again, that's classic for close of the week. You know, it's made its low here and then off the high formed on Thursday. We do have a small little imbalance here. I've mentioned that on yesterday's video. Do we need to trade up into that? I don't know, to be honest with you. I'd prefer to see it left open now. This tail, okay, or wick if you want to call it that, we've always called them tails on the bottom of the candle, but nonetheless, the consequent encroachment of that, because we treat wicks and tails as gaps, the midpoint of that, consequent encroachment, you can see we hit that there. So for calibration purposes, when we drop down the lower time frames, these two red levels here are anchored on that daily fair value gap, and in the consequent encroachment of this candle's tail, which is essentially a bearish breaker. So we have high, low, higher high. We're using consequent encroachment there for that gray level, and the blue level down here would be this low here. And I can't recall if my lower time frame showed this lower level, second blue line, but you should be seeing this one, and that's related to that low here. Okay, and here we are on the hourly chart, and we have the fair value gap there. I mentioned I want to see that left open. This is that consequent encroachment of that daily candle's tail on its candle. You see we ran right up into that, okay, right up into it and completely rolled right against the selling off of this move here. After taking a stab at this run, relative equal highs are created. Lots of liquidity was trailed from here and here right above these highs. So they went right up into that. I got an email from someone that one of my staff members thought was funny, because someone in the mentorship, which you know you are, said that, do you think that they ran the market up when I made my stop public? You know, I laughed and said to my wife, I said, you know, I have shared openly now, even though it was a paper trade, there's a lot of people, I'm sure, were looking to sell short the Eurodollar using where my stop is to protect themselves, and then try to ride out that lower run into the objective where I had my limit order in. Maybe they thought that that was like subliminally flashing, hey, here's a signal for you. And when I woke up and saw what they did, they ran up both euro and pound and sank the dollar index. I was thinking to myself, yeah, I made my observations public, and with a lot of people out there, you know, following that, and you know, it did enter my imagination that maybe there was some kind of a tomfoolery event there. Maybe it's you know, something that's completely outside that, but it was something that did enter my mind. Maybe you guys thought that too. Maybe you didn't, but it is what it is. But we did have buy-side liquidity here created. They ran it up in. Consequent encroachment of the bearish breaker. Left that gap open, which I like. Optimal trade entry here, and then retracement back down into the range created from the low to the high. And just nothing really exciting in here for cable. But nonetheless, it did create that pop higher in dollar, which is still hanging by a thread, near-term bullish for me. And we'll see what we get in response to Sunday's opening on cable. 15-minute time frame on British pound versus US dollar. This dashed line here is an old imbalance. Okay, go back into your notes in the previous videos for cable, and you'll see these lines and what they are. I left them there just for the purpose of showing you the optimal trade entry that forms there. And inside this imbalance here, sell side imbalance, buy side inefficiency, we come up and hit it perfectly there. And then the bodies are respecting the old imbalance and the discount low of the SIBI here. So optimal trade entry there, and it runs down for a low resistance liquidity run signature between these lows here. Didn't quite get down below the actual low here, but we did trade through the rejection block, which is the lowest down close price. So little bread and butter type setup there. And that's going to be it for cable. And the homework assignment I gave you was the E-mini S&P futures contract for December. And the symbol was here. And we were looking at studying this low to this high and what framework was there. So let's take a look at that now. If you have not done this homework, stop this video right now. Otherwise, it's a waste. You won't learn as much. You won't get the practical revelations that come by way of personal study and in compare and contrasting what I show you. So this is like the interactive learning aspect. And I got a lot of feedback from a lot of you that are loving these types of lessons because it's taking you into the charts, your own work, your own study, and seeing what you know. Okay, and it's revealing. Some of you are excited to say, wow, I'm seeing what you've said in your chart before I saw it. And others are saying, I have a lot of room to grow. And that's fine, but it's going to help you. It's not like it's not meant for you to say, look how much you haven't learned yet. It's to show you how much you have understanding of, and it'll help groom you in understanding because you're seeing example after example. Think about it like this. If I were to write a book and said choice setups from a price action trader, okay, I just rolled off the top of my head. If that was the book and I was going in to take you into case studies and say, look at this is what I would show you with this and that. That's what every trading book out there does. Okay, I'm taking you to specific segments in the marketplace where your tools that you're learning here should be able to be used in this platform or this medium, so that way you can go in and study it, and it gives you pseudo experience. That pseudo experience that you log in your journal will create, experience nonetheless that your subconscious will revert back to, and your subconscious doesn't recall any painful adversities about these things. So it's tricking your brain with thinking that you had an experience with this when you didn't. But it filters any of the negative. That's why it's important for you not to log or look at what you didn't observe and that I'm sharing, and don't think, I didn't see that. I wish I would have. If you're going to hang your head with that, you're feeding yourself toxic thinking, and you'll poison each one of these exercises and potential pseudo experience for you to glean a gluttony of positive reinforcement for your learning. It's a big psychological trick to teach yourself with hindsight moves, and it gives you logic the same way you would if you went out and bought a book. Okay, the same way if anybody goes out and buys a book and they're learning a setup or a method, they're seeing examples. Well, I'm giving you the way to go into them without showing you them right away. I want you to go in using what you understand right now and tear into this specific segment of price action, and then ferret out what you see. And then I'll show you with my experience what you should see, okay, or at least what's most important to me. And over time, you'll find that these examples help build a foundation to really put that little exclamation point on how much you have grown in your understanding. It does not matter if you did or did not take these specific trades. It's for your understanding and your edification that we go into them, because this is how you learn. All right, so with that, take the video and hit stop if you have not done this homework assignment. But you want to go through every single one of the charts from daily, 4 hour, 1 hour, 15-minute time frame. And if you feel so inclined, you can drop down to the 5-minute chart. But we're looking at this low to high. So break that down and figure out why it went from here to here. I'm about to show you now, so if you haven't done the homework, you're ruining it for yourself if you continue watching. All right, so here is the E-mini S&P daily chart, and I have the rejection block here, which we mentioned in our movement from here to here. Small little imbalance there, that's noted. And we have the mean threshold of the bearish order block right there. Okay, midpoint of that closed candle. And what I have is an overlapping of the Dow futures and the NASDAQ futures, and their symbols are shown here respectively. And what I want you to notice is, if you look at the low here and the low here on the E-mini S&P, notice that this low is lower than that one. Notice this low on the NASDAQ futures is higher in comparison. So this is lower than this one, while this one here on S&P is lower there. So right away we have a divergence. and you can see the Dow has its low and then lower low here respectively. So by looking at those things, you can see the S&P went lower, NASDAQ futures failed to make that lower low, and the Dow futures made a lower low. So that is a index SMT divergence. Okay, so stock index comparing and contrasting. NASDAQ shows an unwillingness to go lower as the S&P drops down into a discount array, order block, rejection block there. And with this divergence intact, and it's starting to rally here, and this is rallying. When we drop down in here and we start to see movement off of this consequent encroachment of this old imbalance there, that supplies strength to at least running up into the low or the opening of this bearish order block. And if it can run even deeper, mean threshold. Now we do have relative equal highs in here, and we might want to see a run above those as well, but that's outside the scope of this teaching. So from a line chart basis, you can see again, there's a divergence, and this line here is plotted on the lows. Okay, so when you do a compare tab and you add this symbol here, click on the name of the futures contract and click the settings and change it to a line chart and plot it on a low, not the closing price that it defaults to. When you create a line chart, you want to plot it on the low, because what you're comparing is the lows to measure accumulation on the buy side. So the low here to here, again, divergence between NASDAQ, and then obviously the lower low on S&P. So this is an index divergence SMT study. So it's measuring professional accumulation. All right, so we have the hourly chart in here, where we traded down into that rejection block, and then the imbalance. And then we have an order block here on the hourly chart. We trade up and then break lower, consequent encroachment between the fair value gap and then the order block. It hits it. What is this pattern here? Optimal trade entry. Overall, what is this entire fractal? Market maker buy model. Consolidation, leave it, distribution, another level distribution, more distribution, smart money reversal, low risk buy, reaccumulation, another level of reaccumulation, more accumulation, and then we should likely see it run up into that buy side liquidity pool. Okay. In here, we have an order block, fair value gap, optimal trade entry here as well, and then rallies up. Last two down close candles here, order block, optimal trade entry, and rallies up. It hits the bearish order block on the hourly chart there. All right, moving on into the 15-minute time frame. You can see that order block from the hourly chart. Trades into it there. Buy side imbalance, sell side efficiency, consequent encroachment, just about almost there, not quite, but nonetheless, institutional order flow entry drill, rallies up. Now, you can look at this and see another market maker buy model. I know they don't all look as perfect as the ones I'm sometimes showing you with the rectangle boxes and helping you visualize it, but the premise is still the same. If you're bullish and you're expecting price to react in here, the buy side liquidity here is what it would be a target of. So it's consolidation, leads consolidation distribution, another level distribution, selling off in other words. Smart money reversal, low risk buy, accumulation, reaccumulation, and then clears the initial buy here. And it does go higher, but I just want to show you this setup in here on the 15-minute time frame. So we have the order block and the fair value gap. So the market trades up and then down in, right into that. That's potentially bullish as well, because it could still rally up into that daily bearish order block, which is not traded to yet here. And that takes us right over here. So it rallies from here, creates another optimal trade entry here, order block, fair value gap here, rallies up, order block, 1, 2, 3 down close candles, all consecutive, extend it out in time, hits it there, rallies up, another optimal trade entry, fair value gap, order block, and it rise up relative equal highs, but with a low resistance liquidity run signature, lower high to the left of the higher one. And then we still have it here too. This high is slightly lower than this one, so we have a low resistance liquidity run signature for the buy side resting here. All right, so let's go in and look a little bit deeper with accumulation. So here is that buy here, and then we consolidated. Look at these lows right in here. We have a low, lower low on the 15-minute time frame. On the Dow futures, this line is plotting the cumulative line of each individual candle for 15 minutes, the lowest value. So that's what you're looking at here. So we're looking at the low and lower low seen here in S&P and plotted against a line chart on the Dow futures on a 15-minute time frame. You can see that we diverged there. So this is showing professional accumulation, where this is just a stop run. So one of the things that I get questioned a lot by students in the mentorship and folks in the YouTube section or community, how do you know if it's going to be a stop run or if it's going to continue? Well, when you look for these types of things here, you have to have a bias and an underlying premise what you think the market's going to do. So if you're not underlyingly short-term bullish here, then you wouldn't expect this stop run, and you wouldn't expect to see this either. But if you look at a higher time frame chart and see what it's likely to do, and we showed that the three averages, the S&P, the Dow, and the NASDAQ, they were diverging on its daily chart at a time when the S&P went into a bullish discount array. So it could pop, go higher. And now you can start looking for reasons to look for accumulation. And this is showing professional accumulation. If you look at the NASDAQ didn't show so much of accumulation on the lows. It went lower. Again, the Dow failed to make lower lows. At the same time, this went lower on S&P. NASDAQ followed in suit with lower lows, met with the lower lows in S&P. So we only need one. One of those averages have to diverge. Now, it might be a time where you're looking at the S&P and the S&P itself fails to make the lower low, like, for instance, the Dow does. And maybe the S&P does this where the Dow and the NASDAQ make the lower low, but the S&P doesn't. That's still the same thing. It's showing professional accumulation. Okay, and now bringing in the bond market. We're plotting the 30-year bond market, December contract. This high here, notice that we did not make a higher high in the bond market at the same time that we did make a lower low in the S&P. That is a divergence. That's significant. And this turning point here, we'll come to that when we drop into a 5-minute chart, but that is also directly related to this area here. Okay. So on the 15-minute time frame, we drop into that area on the bond chart, and we take you back up to show you where I'm focusing here. This, okay, this time period right there on that day on a 15-minute time frame, we're looking at the divergence between the 10-year, the 30-year, and the 5-year. I'm plotting it here on a line chart, and I'm plotting it on the highs because we're looking for selling or bearishness. So you're going to be plotting and showing a study by contrast between each respective bond market, their highs. And you want to see divergence. Higher high here, lower high there. And that is where you expect weakness on bond market and then anticipate bullishness on S&P and all the indices, like Dow futures, NASDAQ futures. And the second divergence, which I said we'll drop down to a 5-minute chart. Same thing occurring here. This is where I showed you on the 15-minute time frame, but we just transitioned to a 5-minute chart. For the sake of seeing where the divergence is, we have the higher high here, the higher high here, the lower high there. That means we should expect to see lower prices in bond markets. And then we should, and by contrast, expect to see higher prices in S&P. This is where the 5-minute divergence occurs, 15-minute divergence there. You can look at also how We went lower here on the S&P. We did not make a higher high in the bond market there. So one might argue, why did you not do something with the 15-minute time frame? It did diverge. I just want to show you how you can reduce it and get more confirmation and I guess courage by using the lower time frames to see the actual turning point. And when that does turn, it should allow for bullishness on the S&P, and you see that happening here. Everything's opposite, so bond market should be dropping. Intermarket relationship is the opposite on S&P. It should be rallying. So we'll always want to look for a divergence from these two markets because they'll dance together nicely when they're trending or allowed to move. But if they're held in consolidation, like the bond market for a long time was being strangled and it just didn't know what to do. Okay, so interest rates were being held in a lock, and we couldn't use the interest rate market to help us, which made it more complicated. Not impossible, it just made it more complicated. But now you can see when you have the benefit of using the bond market, it's like that little skeleton key, as I mentioned before. It's that silver bullet, that just perfect little, well, cheat code. That's what it feels like to me. And the bond markets will unlock everything. But without the importance of the bond market behind you, it can create a lackluster analysis and give me any confidence to be in there risking a whole lot of money with high-end risk when I can't see or decipher anything from the bond market. But when the bond market speaks, it makes these markets really, really easy to see. And again, you're not trying to time it exactly. So don't think in the beginning that you're going to be able to see that right away and go, oh yeah, I'm going to go right in and do something with that. If it starts to move and it starts to break down, that's fine. Then you can start using institutional order flow entry drill on the lower time frame 5 and 1 minute charts to get in sync with the S&P. And there's nothing wrong with that because you're not chasing it. You're still buying a discount or raise. It's just you're waiting for further confirmation. You won't get the lowest lows, but you don't need the lowest lows. I already taught you the examples to see that that's not a necessity. And I think that, my friends, is going to be it for this one. And I think that's going to be it. I will catch up with you, obviously, on Tuesday. And like I said, if I can, I will try to do something on Monday. If I can't, don't be alarmed, because I've already said in the beginning of this video, and it's already noted on the video post in the forum, that there won't be a video on Monday. So I think that'll be enough for today. Enjoy your weekend. Try to find a way to relax and spend time with your family. And I'll touch base with you next week, Lord willing.